Joining us now for more is JoAnne Feeney, partner and portfolio manager at Advisors Capital Management. JoAnne, great to have you. Maybe you can clear this. I'm confused. You can clear this up for me. What happened? We went through this scare period where it seemed like the working class consumer was getting stretched by higher housing costs, a heavy debt load, and that wealthier consumers would have to carry things through the rest of the year. But right now, doesn't it seem like everybody's a bit stronger?
Yeah, John, the consumer has been remarkably strong, counter to some people's expectations. And the reason for that largely is because they've gotten jobs. They've gotten jobs and wages have been rising, and so they have more to spend. Now, to your point, the lower end of the income distribution is still struggling with the cumulative effect of all that inflation we had. They are being extremely budget conscious. And so, we see companies like Dollar General, for example, suffering. They just don't have room to get any cheaper. While companies like TJ Maxx are beneficiaries as some folks in the middle part of the income distribution try to find some bargains.
JoAnne, so to that point, and you said that Dollar General was one of the names where you're seeing some pressure. And the CEO, of course, on the conference call was talking about how they're seeing slowing sales patterns towards the end of the month when perhaps consumers are running out of money until those paychecks or other forms of payment come in at the beginning of the month. So I guess what I'm wondering is when we keep getting these reads on inflation, yes, the rate of inflation is getting lower, but I'm still stuck on the point that prices are still elevated, right? Like you still know if you're a consumer that has a limited amount of income that you're paying 20% more than you were in 2019. So how do you really sort of grease those wheels again to get them spending without large price cuts, frankly?
Yeah, no, Courtney, you can't get blood out of a stone, and they have suffered. A lot of folks, particularly, paycheck to paycheck folks, really have had to trim what they put in their basket to bring home. But that doesn't tell the aggregate story. Clearly there, again, more people employed, higher wages, even though you've had that cumulative effect of inflation. But it really means that to select places to invest in the consumer space, one has to be really careful because some stores are simply going to face those real budget-constrained consumers, while others are going to benefit from it. So, yeah, the cumulative effect has been devastating for some households, but that doesn't mean that the aggregate story is a negative one. In fact, it's been surprisingly robust.
So, JoAnne, you like Amazon as one of your retail picks. I'm wondering at this point, what's special about Amazon in this omni-channel environment? We're just talking to Kimco's CEO, talking about how, having the physical presence lowers some of those costs. Has Amazon just built such a moat with its unique logistics network that it can manage all of those different issues and still do what investors expect?
Yeah, John, logistics certainly help Amazon a lot, but also just the scale they have in buying. Not only internally sourced stuff, the more Amazon brands, but the third-party relationships that they've built up gives them a real cost advantage. And they also have those subscription fees that help bring in more income on that. So, for a consumer, the convenience is unbeatable. But other companies, traditional brick and mortar, are also playing the online game, and they're using that storefront to help sell more online, like Williams-Sonoma, for example. They cited this early on in the pandemic, that their storefronts were being used as sort of have a look around, see what you like, touch and feel the merchandise, and then people would go home and they know the quality they're going to get. So I think the brick and mortars also are taking advantage of delivering convenience to the consumer. And those that do it well, like Williams-Sonoma, really are benefiting also.
JoAnne, before we go, if we can sort of zoom back out to where we introduced you, you don't agree with where the market is pricing in the amount of rate cuts that we will or won't see. What are your expectations and why?
Yeah, I think it's more likely than not that we're going to see fewer rate cuts next year than the market is expecting. And so there's obviously a lot of uncertainty. We do expect a cut next week. But next year, there are just so many variables that have yet to become clear, in particular tariffs and labor supply. If immigration is significantly curtailed, that's going to put upward pressure in a lot of industries like agriculture, construction, travel, and leisure. And that kind of impetus to higher inflation will require a response from the Fed. And then, of course, on the tariff front, maybe these conversations that we're hearing about are being used as a negotiating tactic, But if we see any kind of significant tariff increase, that's passed directly to consumers. Not only is that a short-term increase in inflation, which again could curtail the Fed's desires to cut rates to help the labor market, but it's also going to constrain consumer budgets even more, going back to what else we talked about.
Yeah, exactly. So many moving parts there to try to figure out and navigate, but thank you for helping us try to get there. JoAnne Feeney.